As the U.S. markets are closed for the weekend, we are looking at the final figures from Friday, November 14, 2025. Nuburu, trading under the ticker BURU on the NYSE American, closed the session at $0.2488 per share. This was a decline of 2.77% on the day, or just over 0.7 of a cent. What's far more significant than the modest price change, however, was the staggering volume. Nearly 27.6 million shares changed hands on Friday alone. For a company with a market capitalization of only around $32 million, that is an extraordinary level of activity, representing a massive percentage of its entire public float. This is not the kind of trading you see in a stable, predictable company. This is the signature of a stock in the midst of a profound, high-stakes conflict between its past and its potential future. And the immediate reality that most casual observers miss when they see this sub-25-cent price is that Nuburu is fighting a war on two fronts, one for its very financial survival and another to completely redefine its corporate identity, moving far away from the story that brought it to the public market in the first place. The expectation for a stock this low is that it's a simple, speculative lottery ticket on a single technology. The reality is that you are looking at the ticker for what is attempting to become a miniature defense and technology holding company built on a foundation of precarious financials and a flurry of recent acquisitions, all while its original core business is hemorrhaging. Let's establish the common ground. When many retail investors, perhaps using the Robinhood app or a SoFi Invest account, screen for volatile, low-priced stocks, BURU is exactly the kind of name that pops up. They see blue laser technology, they see applications in electric vehicles and defense, and they see a stock that traded near $1 within the last year. The temptation is to believe this is a ground floor opportunity, a high-tech gamble that could mirror the early days of far greater companies. This is the narrative of self-investing, the search for that one overlooked idea. But this expectation is where the danger lies. This isn't a simple tech story. This is a complex corporate drama. The deeper reality is found in the company's own filings and its recent deluge of press releases, which paint a picture of a company in a desperate race against time. Let's start with the financials, the bedrock of any investment. Nuburu's recent third-quarter results were, to put it mildly, alarming. The company reported a gross margin of 0. Not low, but 0. This indicates its cost of revenue was equal to or greater than the revenue itself, a fundamentally unsustainable position. This was coupled with an accumulated deficit that has swelled to over $172 million. As of the end of September 2025, the company had only $5.9 million in cash, and more recent balance sheet data suggests its shareholder equity is deeply negative, to the tune of over $44 million. Negative shareholder equity means the company's total liabilities exceed its total assets. It is, by definition, insolvent on its balance sheet. This isn't a company that's funding growth from profits. It's funding its very existence through dilution and debt, relying on things like a $100 million standby equity purchase agreement to keep the lights on. This is not the stock you'd find in a Schwab Intelligent Portfolios account or recommended by a Fidelity Wealth Management advisor. This is the absolute opposite end of the risk spectrum. Now, look at how the company is reacting. This is where the story gets fascinating. Instead of just focusing on its core laser business, Nuburu has initiated a transformation plan. This plan, under a newly implemented dual CEO structure, appears to be a rapid pivot away from being just a laser maker and toward becoming a diversified defense technology provider. The news flow in the last 6 weeks has been dizzying. On October 22nd, the company announced a strategic alliance with Maddox Defense to form a joint venture focused on military and commercial drone systems. Then, on October 31st, it announced it was completing the first phase of an acquisition of Orbit SRL, an Italian company specializing in operational resilience software. And just this past week, on November 12th, Nuburu announced a renewed partnership with TechniForge, another Italian firm, this one focused on special mission vehicles and defense systems. The company is actively trying to buy its way into the defense sector, seemingly using its public stock as currency to roll up these other entities. This strategy is fraught with risk. It's an attempt to build a new house on a crumbling foundation. The market is clearly struggling to understand this. Is this a brilliant pivot, or is it a desperate diversification? The 27.6 million shares traded on Friday suggest a battlefield between believers in this new defense tech transformation plan and those who are looking at the $172 million accumulated deficit and running for the exits. This massive volume is also a sign of the extreme dilution. The company is funding its operations and these acquisitions by issuing new shares, often at very low prices, which puts immense constant pressure on the stock. This isn't the kind of stable, online investment that grows steadily. It's a high-velocity, news-driven trading vehicle. People using sophisticated interactive brokers trading platforms might be playing the short-term volatility, but it's a dangerous game. This pivot is so sudden and aggressive that it's even caused administrative turmoil. In mid-October, the NYSE American Exchange actually sent Nuburu a warning letter for non-compliance. It wasn't about its financials, though it has those problems too. It was because the company announced its new dual CEO structure in the middle of the trading day, without giving the exchange the required advanced notice. The company resolved the issue within days, calling it a simple administrative delay, but it highlights the chaotic, fast-moving nature of this transformation. It's a company that is moving so fast to change its story that it's tripping over its own procedural shoelaces. This is far cry from the steady, predictable management you'd see at a company like Fidelity, which is known for its conservative Fidelity brokerage services and long-term Fidelity IRAs. So what about the original story? What about the blue lasers? This is the technology that was supposed to make Nuburu a key player. The science is genuinely interesting. Traditional infrared lasers, which are used in most industrial welding, are not well absorbed by materials like copper and aluminum. They tend to reflect the light, leading to spatter and defects. This is a huge problem for electric vehicle manufacturing, which requires welding thousands of copper joints for battery packs and bus bars. Nuburu's high-power blue lasers, by contrast, are absorbed at a much higher rate by these reflective metals, allowing for cleaner, faster, defect-free welds. The expectation was that as Tesla stock and other EV makers ramped up production, the demand for Nuburu's unique technology would soar. That was the simple, compelling narrative. But the reality, as shown by the zero gross margin, is that the company has failed to commercialize this technology profitably. The R&D is expensive, and scaling up manufacturing is capital-intensive. It appears the company burned through its cash trying to make this original dream work and has now pivoted to a new one, defense. The blue laser is no longer the sole focus. It's just one piece of a proposed defense and security platform, tucked alongside drone JVs and Italian software companies. This is a common tale in the microcap space, a brilliant technology that fails to become a brilliant business. This is why looking at Nuburu's stock chart on a Fidelity mobile app or through SoFi investing tools can be so misleading. You see a 25-cent stock, but you're not buying one company. You're placing a bet on a highly complex and risky corporate restructuring. You're betting that this new dual CEO team can successfully integrate 3 or more new defense-related businesses, all while the core business has no gross margin and the company is dependent on dilutive financing to fund its $2.7 million in quarterly operating expenses. It's a world away from the relative safety of buying Apple stock or tracking the semiconductor-driven movements of NVIDIA stock. Those are established empires. This is a tiny, struggling state attempting a radical reinvention. So given this pivot, comment below, do you think Nuburu's future is in defense or in electric vehicle batteries? The company is clearly signaling defense, but the original EV market potential was arguably much larger. Looking forward, there are 2 distinct paths for Nuburu, and the gap between them is a canyon. The bull case, the one that the 27.6 million shares of volume might be sniffing at, is that this transformation plan is a masterstroke.